Welcome to the deep dive. We take stacks of sources, pull out the key nuggets, all to get you well informed fast. Today, we're diving into something really fascinating, the hidden emotional side of financial markets. Yeah, our main source here is David Tuckett's book, Minding the Markets. It's pretty groundbreaking stuff. It really challenges the old way of thinking about economics, brings in psychology, psychoanalysis, even neuroscience, and it's based on tons of interviews he did with actual fund managers, real world insights. So, our mission today to unpack why markets act the way they do, especially in a crisis, and really discover how deep this psychology stuff goes, how it shapes investment choices, market stability, everything. Get ready for some potentially surprising ideas that might change how you look at money and markets. Okay, let's get into it. When we think about financial markets, usually it's, well, numbers, right? Algorithms, rational choices. Traditional economics, for ages, basically push this view. Market players, oh, they're objective, consistent, always chasing the best return.
Right. And what's really interesting there is how these standard theories, like the efficient market hypothesis, they sort of assumed, well, a kind of mindless economics. They pretty much ignored the real fluctuating emotions, the euphoria, the panic that you see all the time in markets, which makes you wonder, if the models ignore human behavior, how accurate can they really be?
Exactly. And even when behavioral economics arrive, people like Kahneman and Tversky showing our biases.
Yeah, Nobel Prize winners for that work.
Yeah, showing we're predictably irrational sometimes. But even then, it often just felt like rational versus irrational, black and white.
It did. It often missed the sort of deeper ongoing effects of emotion, group psychology, especially when you're making big calls under real uncertainty. Think about George Ekerloff's famous Lemons paper back in 1970.
The used car market thing.
That's the one. So his formal analysis was about information asymmetry, sellers know more than buyers. But underneath that, it hinted at something more. It suggested confidence, which is, well, an emotional state, right? Confidence is vital for trust. If buyers don't trust sellers, the market just breaks down.
So emotion was always lurking there, even if it wasn't the main focus.
Implicitly, yes.
Yeah.
Decades ago, but often overlooked.
Okay, so given this emotional angle, what is it about financial assets themselves? Why do they seem to stir up so much emotion?
Well, that's a great question. Unlike, say, buying a chair or a phone, financial assets have some really unique features. First, this is crucial, deciding on a financial asset isn't just a one-off. You buy a stock.
You don't just forget about it.
Exactly. You have to make that decision again and again and again, Tuckett says. As long as you hold it, my value is always uncertain. That creates this constant emotional conflict.
Right, that should I hold, should I sell feeling. Okay, what else?
Second, they're fundamentally abstract. A share certificate, or more likely, just a line on a screen. It has no value in itself, only what you can trade it for.
Yeah, you can't sit on your Apple stock like you can a sofa. Totally different experience.
Very different subjectively. And third, the feedback you get is, well, it's noisy. It's incredibly hard to know for sure if your good run is skill or if your fund manager is brilliant or if it was just dumb luck.
Oh, tell me about it. Was that genius or did I just get lucky?
Yeah.
That's a constant question.
It's super unreliable. Makes it tough to judge performance, tough to trust advisors. So these three things together.
The constant decisions, the abstractness, the noisy feedback.
Yeah, they create this environment where emotional conflict and uncertainty are just baked into the system.
Okay, so faced with all this uncertainty, this emotional pressure, what do we humans do?
We do something very, very human. We tell stories. Exactly. Narrative is fundamental. It's how we make sense of things, how we decide what feels true, how we find the conviction to actually act, especially when the data is fuzzy. The neuroscientist Antonio Damasio even argued our brains are basically natural storytellers,
Always
weaving perceptions, memories into coherent tales.
And Tuckett talks about something deeper, these unconscious fantasies, spelled with a phi.
Yes, fantasиes. These aren't just daydreams. They're deep, emotion-soaked mental scripts, often unconscious. They shape how we see money, risk, our own actions. They're like these hidden blueprints for how we engage with the financial world.
Oh, okay.
And that leads to this really powerful concept, the fantastic object, with a
It's
fee.
fantastic object, like.
Think of an idea, an asset, maybe a hot tech stock back in the day, or a complex new derivative that becomes incredibly attractive, almost idealized in our minds. It seems to promise everything, wealth, security, maybe even outsmarting everyone else.
Yeah.
It taps into really deep desires. Hugely exciting.
Like the dot-com bubble stocks or maybe some crypto phases.
Could be examples, yes. anything that generates that intense, almost magical belief. And when these things catch on,
Something happens in the group.
precisely, Tuckett calls it group feel. It's this state where a whole group of people, maybe even people who don't know each other directly online or whatever, they start aligning their thoughts, their actions, based on this powerful, maybe not fully conscious, desire to feel the same way as everyone else.
Like a kind of emotional herd mentality, but deeper.
Sort of, yeah. In this group feel state, doubt just vanishes. Critical thinking gets fuzzy. Judgment is impaired. It encourages what he calls a divided state of mind. You kind of split off uncomfortable thoughts, conflicting data. You just don't think them.
You turn a blind eye.
Exactly. A collective blind eye to obvious risks. It helps explain how, before big crises, warning signs were ignored, rules were bent, and why serious skeptics, like Warren Buffett warning about those financial weapons of mass destruction before 2008.
They get dismissed, laughed at even.
Yeah, because they disrupt the group feel, the comforting story.
So these psychological forces sound incredibly powerful. How does this actually look on the ground for the people making the billion-dollar decisions?
Tuckett interviewed them, right?
He did extensive interviews with very senior fund managers, people managing huge sums, often for over a decade. Their stories are, well, they're illuminating.
What did he find? How did they really make decisions? Was it all spreadsheets?
Not at all. They pretty much admitted pure rational calculation wasn't enough. They often relied on, as one put it, touchy-feely guesswork. They built conviction by fitting data into these appealing themes or stories. They needed to engage their emotions to feel confident. Like one manager, Fred Bingham, talking about sound healthcare. He didn't just list financials. He called it a lovely business, a money-making machine. Talked about its order book stretching forward years.
You can really feel the conviction there, can't you? It's not just numbers.
Not at all. It's an emotional connection.
But hang on, if they're getting emotionally invested, how does that square with the insane pressure they're under? Performance pressure must be immense.
Oh, absolutely immense. That came through loud and clear. Many, like a guy named Colin Menton, admitted checking their performance constantly, daily, sometimes hourly.
Hourly, wow.
Yeah, saying it makes or breaks your day. And Leonard Frost put it bluntly, I have a view that you only really make money in this industry if you don't sleep at night.
Yikes. That sounds unsustainable.
It creates this huge conflict. Another manager, Quentin Matthews, said it perfectly. Commercially, it's sometimes very difficult to behave in a way that's rational. Meaning what's rational for the long-term health of the investment might be totally irrational for keeping your job next quarter.
Ah, the short-term versus long-term trap.
Exactly. And this conflict leads to defensive stuff like selling winning stocks too early just to lock in a profit, capping profits, they called it, or missing out on good runs because they were too scared of getting caught in a bubble, like another manager, Darren Cook.
So it cuts both ways, fear and greed, but driven by these deeper commercial pressures too. Okay, so what about their buy stories? What psychologically convinced them?
Well, a lot of them felt they had this special ability to see the truth, like Mark DeVreau, who felt he was seeing through the smog to buy a company called Carr when all the news was terrible.
Seeing what others couldn't.
Right. Or George Monroe finding a valuation discrepancy in utility that the market missed. There's a sense of unique insight. They were also looking for something amazing or special. Monroe got wildly intrigued by Good Food's potential.
That thrill of discovery.
Yeah. And alongside that, they needed lots of security. Fred Bingham, with Sound Healthcare, loved that transparent order book and felt there was no real downside.
So special insight, exciting potential, but also a safety net. An interesting mix.
Very. And trusted management was huge.
Ah, the people running the company.
Crucial. They liked leaders who seemed to understand what shareholders needed, as Mark DeVreau put it. But when things went wrong,
The story changes. How did the sell narrative sound?
often it was about feeling betrayed by management. Duncan Smith felt the execs at Outfits didn't seem to care about the share price. Leonard Frost felt his view on advertising's management was severely diminished after they changed their earnings forecasts. The trust was broken.
So betrayal is a big theme. What else?
A real struggle with suspicion. First, they'd doubt the original story, the information they based the buy on. Then they'd get suspicious of management. They'd wrestle with holding on, lose conviction. And sometimes they'd sell, only to watch the stock bounce back later, like Chuck Bronski did with Lap Wireless. Painful.
Ouch. Yeah. How did they cope with those failures? Must be hard psychologically.
They often framed failures as being caused by unimaginable events, things nobody could have predicted, rather than perhaps unimagined failures in their own thinking or process.
Ah, subtle difference. Unimaginable is external. and imagined is internal.
Exactly. It's a coping mechanism. It lets them protect their sense of competence and get back out there, back to the front line, as they said.
Fascinating insight into that world. Okay, so bringing it all together, given this deep psychological layer, these group dynamics, how do we make markets safer? How do we avoid another 2008?
Well, Tuckett's core point is that 2008 wasn't just a few rogue traders. It was a collective failure, that blind eye again, fueled by widespread belief in those fantastic objects like mortgage-backed securities and the very convincing stories told about financial innovation.
So the solution isn't just more rules.
Not just rules, no. The solution lies in fostering what he terms an integrated state, both in individuals and in regulation. That means encouraging a willingness to actually tolerate doubt, to engage with messy, conflicting realities instead of pushing them away.
So training people to spot this stuff, regulators, investors.
Yes, training people in key roles to understand how seductive, fantastic objects can be, and to recognize the warning signs of divided states and group feel emerging in the market buzz.
Okay. Does he suggest concrete steps?
He proposes 6 main things. First, regulators should make financial firms do proper postmortems on their failures. Document what went wrong, share the lessons, build a collective memory, basically.
Instead of just burying it. Makes sense.
Second, make the risk climate more transparent. Develop and publish red flags, indicators not just hard data, but maybe measures of sentiment, debt levels, things like that.
Okay, shine a light on the mood. What's third?
Regulators need to get tough on how fund manager performance is disclosed. Demand realistic, long-term track records, full fees shown clearly. No more misleading ads cherry-picking the good bits.
Yeah, those ads can be incredibly deceptive, hiding the funds that tank.
Exactly. It should be impossible to misrepresent performance like that.
Yeah.
You, as the investor, need the whole truth.
Agreed. What else?
And this is critical. Tackling the core institutional problem that encourages divided states, the messed up incentives, asymmetric rewards,
You mean huge bonuses for short-term wins?
but no equivalent downside for managers when things blow up later. It basically incentivizes gambling with other people's money. Risk gets transferred, not managed.
Shareholders and clients pick up the tab.
Precisely.
Yeah.
It's inherently dangerous and was a massive factor in '08. Needs fundamental reform.
That all sounds sensible, necessary even, but it leads to a really tough question, doesn't it?
What it is.
Can regulators, or anyone really, say no to the next big shiny thing? That potentially fantastic financial innovation that promises huge returns, creates jobs, generates wealth, at least for a while.
That's the inherent tension, isn't it? It's this deep, maybe unresolvable conflict. And it's a conflict that traditional finance theories, by essentially ignoring emotion and uncertainty, just sweep under the rug.
So our deep dive into minding the markets, it really shows that finance isn't this cold, rational machine. It's incredibly human, driven by our feelings, the stories we buy into, our collective psychology.
Absolutely. And understanding these dynamics, the
Yeah.
lure of fantastic objects, our tendency to create these divided states, the sheer power of group feel. It's not just about stopping the next crash. It's also about making sure capital actually flows towards genuine creativity and productive investment, not just chasing the latest emotional high.
So here's a final thought to leave you with. What if the biggest risk you face isn't just picking the wrong stock, but being in a state of mind maybe swept up in a kind of collective dream where you literally can't feel the potential danger, the weight of possible loss? Something to think about as you navigate your own financial decisions, perhaps.